Welcome to The Explainer. Today, we're demystifying the whole accounting and pricing system behind how money and goods cross international borders. If you've ever, checked the tag on your shirt or thought about the parts inside the smartphone you're holding, you already know we live in a deeply interconnected world. But it goes way deeper than just shipping products around. Modern supply chains mean that a single product might represent financial transactions and labor stretching across dozens of countries. Honestly, open economy macroeconomics is the beating engine of our modern world. So today, we're going to look right under the hood. But before we get into the heavy math and the formulas, ask yourself a pretty simple question. How do the imported items sitting around you right now actually get paid for, tracked, and priced by our country? Well, it's not magic. It's macroeconomics. It's this massive, invisible web of capital and current accounts that basically balance themselves out every single day to keep global trade afloat.
All right, here's our roadmap for today. We'll hit opening the economy, the balance of payments, current versus capital accounts, the foreign exchange rate, fixed versus flexible rates, and wrap up with the open economy equation. Let's get into it.
Section 1. Opening the economy. Let's start with the absolute basic building block. What makes an economy open in the first place?
Basically, an open economy links up with the rest of the world in three main ways. First up is the output market. This is your classic trade of physical goods and services. It's what happens when you buy French wine at the grocery store or an American tech company sells software overseas. It just dramatically widens consumer choices. Second, we have the financial market. This lets investors pick between domestic and foreign assets. So an investor sitting in Tokyo can easily buy U.S. Treasury bonds or stock in an international company. And third is the labor market, where workers choose where to take their skills. Now, obviously, labor movement is heavily restricted by immigration laws and borders, so an open economy really breathes and grows mostly through those first two powerful engines, the output and financial markets.
Moving right along to Section 2, the balance of payments. Now that our doors are wide open, we definitely need a foolproof way to track all this global activity.
Think of the balance of payments, or BOP, as basically a country's master bank statement. It's a comprehensive line-by-line record of literally all transactions between a country's residents and the rest of the world, usually over the course of a year. It tracks absolutely everything, every physical good, every digital service, every single financial asset flowing in and out. Without this master ledger, a country would just be flying blind. They'd have no idea if they were piling up unsustainable debt or building massive global wealth.
To keep all that organized, we move to Section 3, current versus capital accounts. This massive BOP ledger is split into two very distinct halves.
You can think of the current account as your everyday checking account. It handles the trade in goods and services, plus transfer payments like gifts or remittances that don't expect anything in return. Essentially, it tracks stuff being consumed right now, like buying a cup of imported coffee. The capital account, on the other hand, is way more like your long-term investment portfolio or your loan history. It's all about building future wealth. It tracks the bigger, longer-term movements like investments, external borrowings, and government assistance.
Breaking down the capital account, you can see it branches out into highly structured categories. It tracks foreign direct investment, say a foreign automaker building a massive new plant in your state, alongside external commercial borrowings. And these aren't just abstract numbers on a spreadsheet, right? They represent tangible things, real factories being built, local infrastructure funded by external aid, and domestic corporations taking out international loans to expand.
Now here's one of the absolute golden rules of macroeconomics. The current account plus the capital account must perfectly equal zero. It's a strict accounting identity. If a country spends more on imports than it earns from exports, meaning it's running a current account deficit, the money to pay for that gap didn't just magically appear. It had to be financed, either by selling off assets or taking out foreign loans. And that mechanically creates an offsetting capital account surplus. It's a perfectly balanced scale. Every single dollar, euro, or yen leaving the country for a physical good is perfectly matched by one coming in for an asset.
That brings us to Section 4, the foreign exchange rate. We know what's being traded and how we record it, but how do we actually price the money used for those trades?
Since there isn't some magical, universal, global currency, we have to rely on the foreign exchange rate, which is really just the price of one currency in terms of another. I mean, imagine the total chaos in global trade without this. This rate is the crucial translation mechanism of the world economy. It's exactly what lets us figure out how many Indian rupees it takes to buy a $10 American import, completely bridging the gap between different monetary systems.
You hear these terms all the time on the news, right? Depreciation and appreciation. When your domestic currency depreciates, it's basically losing buying power abroad. It takes more of your local currency to buy a single US dollar. Suddenly, that European vacation feels incredibly expensive. But, and this is a big but, a depreciated currency makes your country's exports look like a massive bargain to the rest of the world, which can be huge for domestic manufacturing. On the flip side, appreciation means your currency's value goes up. It takes less local money to buy that dollar, making foreign imports super cheap for your citizens, but potentially pricing your local exporters completely out of the global market.
So, what actually drives these rates to jump around every single day? Well, in the short run, it's all about interest rates. Picture two countries. If country A's government bonds pay 8% interest, but country B's central bank hikes their rates to 10%, a massive wave of global capital is going to chase that higher return. Investors everywhere want that 10% yield. But to buy country B's bonds, they first have to buy country B's currency. That sudden massive spike in demand drives the value of country B's currency right up. It's a perfect example of how interest rate differentials directly drive exchange rates.
Now we know why they fluctuate. Let's look at Section 5, fixed versus flexible rates, to see who actually sets the rules of the game.
Under flexible exchange rates, the open market is totally in the driver's seat. Pure supply and demand dictate the currency's price, automatically adjusting day by day to balance the ledger. Under fixed exchange rates, however, the government steps in and anchors the price, literally guaranteeing conversion at a set rate. The catch? Anchoring a currency requires central banks to hold massive vaults of foreign cash to back up the guarantee. If global investors sniff out that a country is running low on those reserves, they can launch speculative attacks, aggressively shorting the currency until the government goes broke trying to defend it, forcing them to abandon the fixed rate completely.
So, given the massive headaches with both of those extremes, what do we actually do today? We use managed floating. In reality, without a formal international agreement like the old gold standard, most of the world uses this highly pragmatic hybrid system. Some people call it dirty floating. It lets market forces dictate the general day-to-day trend, but central banks will occasionally step in and intervene. They'll buy or sell currencies just to prevent wild, damaging swings that could bankrupt their exporters overnight or cause a sudden massive spike in the cost of imported necessities. And finally, we arrive at Section 6, the open economy equation. Let's tie all this international trade, currency exchange, and accounting back into the big picture of a nation's total income.
In a totally closed economy, a nation's total income, represented by Y, is just a self-contained loop of domestic consumption, plus domestic investment, plus government spending. Simple enough. But the second we knock down those walls and become an open economy, we have to account for the rest of the globe. So, we expand the formula by adding X minus M, our exports minus our imports, which we call net exports. Opening the economy simply adds foreign demand for our stuff and subtracts our demand for foreign stuff.
Every single piece of this expanded identity matters deeply to our national wealth. The domestic factors, consumption, investment, and government spending, create our baseline. But exports, X, well, they act as a massive injection. That is brand new money from abroad pumping straight into our circular flow of income. Meanwhile, imports, M, act as a leakage, where domestic money escapes across our borders to pay for foreign goods. Together, this constant tug of war between injections and leakages dictates our entire macroeconomic reality.
Which brings us to a final kind of provocative thought. We learned earlier that a current account deficit has to be perfectly financed by a capital account surplus. That literally means a trade deficit forces foreign capital and investment into your country to balance the ledger. So if that influx of foreign capital is being used productively, to build massive new factories, fund innovative startups, and upgrade infrastructure, is running a trade deficit actually a bad thing? Think about that the next time you see panic-inducing headlines about trade deficits. Keep exploring how these incredible macroeconomic gears keep turning our world. Thanks for joining me on this explainer.